Good day everyone. We meet again on my next video on global economy and international business. This subject is lectured by our dearest Professor Roy Sembel and Dr. Yulita. Still with me, EKY Kurniawan from EMBA class of 2023, IPMI International Business School, Jakarta. Let's begin. So, what is global economy? Global economy is the world economy or all the economies of the world which we consider together as one giant economic system. It includes everything we all buy, sell, and own on this planet. To simply put, global economy is the giant economy. The term global economy has two meanings. First one being economy of the whole planet or global GDP. GDP stands for gross domestic product. The second one is the way the world today, where countries are interlinked and interdependent to one another, that they all seem like parts of one whole. We call that global economy. We live in global economy where nations are interdependent. We can look at, for example, banking and finance, which today has no national boundaries. If a giant bank in one country collapses, banks in other countries also suffer. In fact, the whole economies might suffer. In this context, global economy also means globalization. Globalization further leads to borderless flow of goods, people, information, and technologies. These free flows promotes international trades among countries. However, these too bring along the positive and negative impacts. Some positive impacts being the faster development of technological innovation, since globalization open access to a much wider talent pool and a much wider cooperations among nations. The flow of foreign direct investment made easy by borderless and standardization of regulations through various economic regimes such as WTO. This leads to the achievement of economies of scale. However, globalization also brought in negative impacts of interdependence among nations, which proved to be both beneficial and disastrous during COVID-19 pandemic period. The free flow of goods, capital, people, and informations also bring threat to sovereignty and creating the inequitable distributions of wealth. Globalization process are made faster by third and fourth industrial revolutions. Third industrial revolutions being the internet age, which open up access to various locations where distance is no longer an issue. Speedy development of computer and mobile devices further unlocked fourth industrial revolutions, which moving into the directions of cyber physical combinations aiming to materialize automation between artificial intelligence and machines. Absolute advantage versus comparative advantage. Absolute advantage, the ability to produce a specific product more efficiently than any other nations, while comparative advantage is the ability to produce a specific product more efficiently than any other product. China, we have a look at the diagram. China has absolute advantage on both wheat and potatoes. However, India has comparative advantage than China in producing wheat. Therefore, each should focus on their comparative advantage, such as China on potatoes, India on the wheat, and then trade accordingly. This is the basic principle on how international trade or international business started. Globalization and international business made multinational corporations flourishing. These firms enjoyed international opportunities such as investment opportunity where they can generate better margins, than domestic firms, since they will have the wider helicopter views on which projects will generate a better opportunity sets. Financing opportunities are also another aspect which are enjoyed by the MNCs for being able to obtain capital funding at lower cost, since they will have a wider funding sources around the world. International business activities require international financial management tasks to ensure the effectiveness and sustainability of the business process. This task consists of first one being choosing a capital structure, determine the ideal long-term mix of debt versus equity financing. Second is to raise funds for the firm, acquire equity, debt, or intra-corporate financing for funding activities and investment. The third one being working capital and cash flow management, how to manage funds passing in and out of the firm's value-adding activities. And the fourth one is the capital budgeting, which is to assess financial attractiveness of major investment projects, example, foreign market expansions and or foreign market entry. The fifth is managing currency risk, manage the multiple currency transactions of the firm and the exposure to exchange rate fluctuations. And the sixth being to manage the diversity of international accounting and tax practices, which is by learning how to operate in a global environment with diverse accounting practices and international tax regimes. So when the firm or a company operating in the international trade or in the global stage, there are three types of exposure that they need to take into account. First one being the transaction exposure, which reflects the exposure of an MNC's future cash transactions to exchange rate movements. So it's a fluctuation of the exchange rate which will affect the future cash transaction. And the second being economic exposure, which measures the direct and indirect risks of cash flow from the exchange rate movement. This is from a wider angle. And then the last one, the third one, being the translation exposure, which focus on consolidated financial statements. And some example has been put on the screen for easier understanding. International taxations, of course, cannot be separated from the tax and regulations. Direct tax imposed on income derived from business profits, intra-corporate transaction, capital gains, and sometimes royalties, interest, and dividends. And the second one being indirect tax, which applies to firms that license or franchise products and services, or the one who charge the interest. Government will withhold some percentage of royal payments or interest charges as tax. And the third one is the sales tax, or the flat percentage tax on the value of goods or services sold and paid by the ultimate user. And the next one being value added tax, or VAT, which is payable at each stage of processing in the value chain of a product or service. VAT will be calculated as a percentage of the difference between the sale and the purchase price of a good. It's very common in Canada, Europe, and Latin America. Each business in the product's value chain required to bill the VAT to its customers and pay the tax on its purchases, crediting the amounts it paid against the amount when the amounts due on its own activities. Net result is the tax on the added value of the good. And then the last one being tax haven, which are the countries hospitable to business and inward investment due to their lower corporate income taxes. Usually MNCs will take advantage of tax haven by establishing operations in them or by funneling business transactions through the tax haven. There are four types of risk in international business. The first one being the commercial risk, where you have a weak partner or operational problems, uh, wrong timing of entry, competitive intensity, and poor execution of strategy. And then second one, you have currency or financial risk, which we have discussed just now, is the currency exposure, asset valuation, foreign taxation, in the inflation and the transfer pricing risk, and also global sourcing. And a company also will expose to the country or political and legal risk, where social political unrest and instability, and then economic mismanagement causing inflation, and distribution of income or size of the middle class, which usually becoming the target market, and then the government intervention, bureaucracy or red tape, change in policy, market access, barriers, profit repatriation. This might be a problem in certain countries, and legal safeguards for intellectual property right. And the fourth risk in international business is the cross-cultural risk, which is understanding the difference in culture or the cultural distance, and then negotiation patterns, which can be varying from country to country, and then also decision-making styles and ethical practices. There are many factors that affect currency exchange rates. The first group being those affecting the supply demand of goods or services, whether it comes from the domestic or foreign, as inflation rates, income, government restrictions on flow of goods or services. And then the second grouping being those affecting the supply or demand of securities, either domestically or foreign, such as from the interest rates, government restrictions on capital flow. These two groups, which is good or service demand supply and security stocks, will eventually influence the amount of supply and demand on foreign currencies versus domestic currency. The other factor being risk perceptions of investors. These are the factors which are affecting exchange rate fluctuation. Globalization has brought along some issues which are impacting nations involving in the global economy. Issues such as subprime mortgage crisis, which caused a shock on the stock market, bankruptcy on major financial institutions, recession on some world economies, which led to reforms on the systems. Globalization also created a situation of volatility, uncertainty, complexity, and ambiguity. These qualities that make a situation or condition difficult to analyze, difficult to respond to, or difficult to plan for. Firms need to maintain vision to fight volatility, need to seek an understanding to fight uncertainty, and also need to find clarity in order to fight the complexity. And last, it needs to remain agile in the situation of ambiguity. Let's move on to the other aspect of globalization, which is the international trade or businesses. Flourishing of international trade or business with free trade principle as the main key has generated standardization, which was done on tariff and quotas. Tariffs are tax placed by the government on imports. They raise the price for consumers, lead to decline on imports, and can lead to retaliation by other countries. Over time, tariffs have fallen worldwide, normally higher on lower income countries, partly since they rely on them for government revenues. Tariffs are usually higher than on agricultural products, apparels, manufacturing, and textiles, while quotas are physically limits on imports volume. Quotas do not generate revenue for government. It's usually meant for protections of domestic products. Both tariff and quotas are usually double-edged swords, used for either the positive impact as well as used as weapons in trade wars between major players. Globalization also generates standardization of labor treatment, such as basic labor rights to organize, bargain collectively, prohibition of forced labor, cessation of child labor, Non-Discrimination Act, and also another product of standardization is the trade and protection of environments. Firms doing international business can be distinguished from their level of business activity, such as domestic business, which operates mainly within single country, and then international companies, which are basically importers and exporters. They have no investment outside of their home country. Multinational companies has a location or facilities in multiple countries, but each location function in its own way. Essentially, it is a separate entity. Global companies also has location in multiple countries, but they have figured out how to create one company culture with one set of processes that facilitate a more efficient and effective single global organizations. Transactional companies are much more complex organizations. It's a commercial or non-commercial enterprise that operates substantial facilities. It does business in more than one country and does not consider any particular country as its national home. One of the significant advantages of a transnational company is that they are able to maintain a greater degree of responsiveness to the local markets where they maintain the facilities. There are several entry strategies for firms operating in different markets. The first one being home replication, or we can also call it as international strategies. The firm views international business as separate from and secondary to its domestic business. Expansion abroad is an opportunity to generate incremental sales for domestic product lines. Products are designed for domestic customers, and internal business is pursued mainly to extend the life of domestic products and replicating home market success. Example for this is Netflix, Starbucks, Microsoft. Multi-domestic or localization strategy. The firm develops subsidiaries or affiliates in each of its foreign markets and then appoint local managers with local knowledge to operate independently and be locally responsive. Product and services are adapted to suit the needs and wants of buyers in each country, local taste. Because headquarters acknowledges differences between national markets, subsidiaries are allowed to vary product and practices by country. Country managers are often nationals of the host country and generally don't share knowledge and experience with managers in other countries. Example of this is 7-Eleven, Nestle, Frito-Lay, Johnson & Johnson. So global standardization strategy headquarters seek substantial control over all country operation in order to minimize redundancy, achieve maximum efficiency, learning, and integration worldwide. Such a company is only concerned with going global and covering as many nations as possible. Global strategy asks, why not make the same thing the same way everywhere? Products, marketing, and company practices are relatively standardized with little adjustment to local preference. R&D, manufacturing, marketing, and other activities tend to be concentrated at the headquarters, where they can be centrally coordinated and controlled. The example is Red Bull, Domino's, and Pizza Hut. And the fourth one being the transnational strategy. This is a combination or coordinated approach to internationalization in which the firm strives to be more responsive to the local needs while retaining sufficient central control of operations to ensure efficiency and learning. Global brand home country headquarters maintain tight control. The firm seeks to combine the major advantages of the multi-domestic and the global strategies, so while minimizing their disadvantages. It's flexible in approach, standardize where feasible, adapt when appropriate. And there are several market entry strategies for global market. First one through export-import operations, usually through agent. Second one by setting up wholly owned subsidiaries. Third one by doing merger or acquisitions. Fourth one being alliances and or joint ventures. Fifth one is licensing, which is an arrangement whereby a firm allows other company to use its brand name, trademark, technology, patent, copyright, or assets in exchange for royalty based on sales. And the sixth one being franchising, which is a method of distributing products or services involving a franchisor who establishes the brand's trademark or trade name and a business system, and a franchisee who pays a royalty and often an initial fee for the right to do business under the franchisor's name and system. So in order to For firms to effectively operate in international business, other than market and strategy, firms also need to have understanding on cultural differences and adapt business practices effectively to operate cross borders. Having a good reference and knowledge on legal frameworks, also especially international trade laws and local trade laws and local regulation, as well as intellectual property protections, is a must. We have come to the end. In conclusion, the study of global economy and international business provides a comprehensive understanding of the interconnectedness and dynamics that shape the contemporary business landscape. Throughout our exploration of this subject, we have delved into various aspects, including global trade, economic integration, multinational cooperation, and the impact of geopolitical events. The global economy is in a constant state of flux, influenced by factors such as technological advancement, political developments, and cultural shifts. The key takeaways being interconnectedness, economic integration, multinational corporations or MNCs, geopolitical influences, sustainable business practices, and crisis and risk management. Thank you very much for listening, and see you again on next video. Goodbye.